Okay, so it's a presidential election year, and really everyone's all abuzz about what the stock market will do. And you know what? Every 4 years, I hear the same thing from people. Oh, the stock market is going to crash because it's an election year, or if so and so gets elected, that's it. The market's going to tank. Well, my name is Keith Wilson, and I am a financial advisor helping folks just like you navigate their way through the markets. And in this video, we're going to look at election years and the stock market. Is it true that the stock market doesn't do well in election years? And if one person wins over the other, will the market crash? Or is this a myth that can be busted?
Lightning strikes and then you're gonna know my name.
All right, let's get right into it. You might have heard that stocks do not do well in a presidential election year, and you may be worried about what your investments will do. But just because it's a presidential election year should not mean that you have to run for the hills because you think the market will crash. If you base your investment decisions on emotions, that could be a mistake. So first, let's look at history and see what the data shows in a presidential election year and see if this myth can be busted. Okay, so there have been 24 presidential election years since the S&P 500 index began in 1928. And according to First Trust, of those 24 election years, 20 of them have been positive. In other words, what I'm saying is 83% of the time, presidential election years have been positive. Only 4 years were negative, and those were in 1932 and 1940 during the Great Depression under Roosevelt, and in 2000 during the dot-com bubble crash under Bush, and in 2008 with the Great Recession when Obama was elected. And in all election years since 1928, the average return of the stock market, well, I should say the S&P 500 index, the average return of all election years since 1928 was 11.58%. So if 83% of the time during an election year it was positive with an average return of 11.58%, then to say that stocks do not do well in an election year, well, I think we can safely say that myth is busted. Now, markets may be more volatile during the year of an election year, especially leading up to voting day, with an average drawdown of 17%, according to JP Morgan. But typically, when results are announced, markets tend to rally because there is more clarity. But what about the notion of if one candidate wins over the other, will markets crash? Well, let's look at that and see if that myth can be busted. But hey, before we do, go ahead and subscribe to this channel. Give the video a thumbs up. Helps me more than you know to get this information out there for others to see. I would really appreciate it. Okay, so do markets crash if one candidate wins over the other? Well, according to JP Morgan, as this chart shows, on average since 1984, markets have been higher 12 months later, regardless of who won. In fact, in the last 40 years, only one time in the following 12 months of an election did the market go down. Now, this is some pretty strong data. So to say if one candidate wins over the other, the markets will crash, well, I think that myth is busted. So there you have it in black and white with history and data. And obviously, historical performance is no guarantee of future results, but while history may not repeat itself, it oftentimes rhymes. And in my opinion, I think what drives the market more than election years is really just the macroeconomic environment, like inflation, interest rates, earnings growth, things like that. Anyway, I hope this puts some things in perspective for you. And if we need to talk, check out the resources below to get in touch with me. And hey, I hope to see you next time.
If I don't know any limitations.